Hi guys, welcome back. Today we're going to be looking at AMD. AMD had a spectacular 2020 and they recently reported their quarter one earnings as well. And especially with this company down more than 20% over the last since the beginning of this year, I believe that this is a fast-growing company that is trading at an attractive valuation. Today we're going to be looking at the stock analysis for AMD. If you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we're going to be looking at today is the quarter one earning report. So AMD's revenue and earnings blew past Wall Street estimates. Their non-GAAP earnings tripled year over year to 52 cents per share, while their revenue doubled to more than $3.45 billion, which was a significant increase from $1.79 billion a year ago. Their reporting of $3.45 billion also beat their analyst expectations by $232 million, which was more than 93% growth year over year, which was primarily driven by their enterprise, embedded, and semi-custom segment, which revenue was up more than 286%. On top of this, their computer and graphics segment was also up more than 46%, which is very, very solid. AMD's revenue is doing extremely well, and their management believes that they can do even better in the future. They expect their second quarter of 2021, their revenue should be $3.6 billion, which is an 86% increase year over year and 4% increase quarter over quarter, which is mind-boggling growth, especially for a company whose PE ratio is just over 30. So what is the future growth in play for AMD? The good news is that AMD expects its Xilinx acquisition, ticker symbol XLNX, their acquisition to be completed by the end of this year, which provide new room for extra growth, and top of this, better earnings and better cash flow as well. The management also has quoted that they see significant demand for the latest generation of Sony and Microsoft consoles throughout the year, because AMD plays a big part in Sony and Microsoft's consoles, especially with consoles reaching an all-time high last year, with Sony selling close to 8 million units of the PS5 as compared to 7.6 million in the first year release of the PS4 as well. On top of this, the computer and graphics segment is also benefiting as more and more people buy or try to build their own PCs. And the company's main driving sales are their Ryzen CPUs and their Radeon GPUs. And on top of this, they're also taking market share from competitors. Their CEO, Lisa Su, has also pointed in their recent earnings conference call that their revenue is growing significantly faster than the market, and particularly in the ultra-thin gaming and commercial segments as well. Their revenue in the client processor space has doubled in the past few years, and especially with their higher-end products and their technological advancements over their biggest competitor, Intel. AMD server processors revenue hit a record last year, with their EPYC processors doubled over the last year or so, as more and more companies switch away from Intel due to the AMD's superior products. The company aims to double the number of cloud companies powered by EPYC processors to 400 this year, and this includes many key players such as Amazon, Microsoft, Alphabet, IBM, Tencent, and Oracle also joining the party. So with this future growth and pretty solid quarter one revenue and earnings, what are the financials for AMD? As a whole, where the financials are pretty good, we're going to be specifically looking at the last 4 years, as before that the company was not profitable. So the earnings per share has increased amazingly over the last 4 years. We're looking at 32 cents to more than $2.37 now. Their operating cash flow, cap spending, and free cash flow has exponentially increased as well. More money is coming into the company, more money is being invested in the company, and more money is being staying in the company as well. The net margin is extremely healthy at 25%, especially for an industry that needs to regularly innovate and do constant research and development. 25% net margin is extremely healthy. Their return on equity is mind-bogglingly 61%, shows extremely good uses of their money and shareholders' investments. So that's an amazing plus for the company. Their interest coverage is also very healthy at 42 years, and their debt is extremely conservative at less than 0.1. Their price to earnings, although the stock price is up tenfold or 100-fold over the last few years, the price to earnings has actually decreased, which means the company is growing faster in the last few years than the share price, which is a very good sign for an undervalued company as of right now. And their PEG ratio is 1.2, which is very healthy, especially for the growth it's trying to show. And especially when we're looking at competitors, it's one of the fastest growing companies out there in this sector. So the next thing we're going to be looking at is the technical analysis. We can see over the last year, the stock price has fluctuated extremely, starting from about $37 going all the way to $90 and is currently trading at $78. From their high of $93, the stock is down 20%. However, if we look at it right now, we can see the stock price is trading near the 200-day simple moving average, and the 50-day simple moving average has not crossed below that, which means the company is A, not on a downtrend, but B, is also trading at one of the cheapest valuations it ever will be. You can see over the last year or so, the stock price has never really come all the way down to this orange line, except now over the last few months, which provides a very good opportunity to buy. So just some final words. This company has great growth. I believe it's kind of a value stock, especially with the PE ratio of 33 and a PEG of 1.2. It may seem a bit pricey to traditional value stocks, but if you factor in the growth it delivers, I believe it's a very good buy. It has good recent financials over the last few years, has improved its balance sheet extremely well over the last 4 years specifically, and I believe it's trading at historically low prices near its 200-day simple moving average as well. So if you do choose to invest, make sure to do your own due diligence, and thanks for watching. Bye.